All right, everyone, welcome. Get ready to dig deep into some pretty wild market shifts lately. We're talking about this extreme risk-on rally that seems to have blindsided quite a few people. We're going to unpack some really intriguing analysis today. It comes from a source that confidently called this situation just a few months back,
Yeah.
which is interesting because they were going completely against those, prevailing pessimistic narratives, predicting like a 2008 style meltdown.
Yeah, it was definitely a contrarian call back then. And our mission today is really to understand how this particular firm used its data to see a very different picture emerging. They even identified a pattern suggesting the market dynamics mimic the 2020 COVID-19 crash. So we'll explore the key indicators they're highlighting and, what they might suggest about where the market's headed.
Okay, let's start there. The source says you need to look backwards to see the future.
Yeah.
So let's go back to, what was it, early April. The S&P 500 formed that death cross. Now, for anyone maybe less familiar, what exactly is a death cross and what was the general feeling about it then? Because I remember the headlines.
Right. So a death cross happens when the shorter-term moving average, usually the 50-day, falls below the longer-term one, the 200-day. So 50 DMA below the 200 DMA. And yeah, the prevailing narrative was absolutely negative. Headlines were definitely doom and gloom for equities. It's traditionally seen as a very bearish signal.
But here's where it gets really interesting, as you said. This source claims they actually proved this specific death cross was, wait for it, a bullish signal. How on earth did they arrive at that conclusion? It seems completely counterintuitive.
It does, on the surface. But they pointed to their own indicator. It's something they call the Big Money Index, or BMI. It's essentially a breadth indicator. What it does is track institutional buying and selling pressure across a wide range of stocks. And what they saw was that this BMI started rallying hard right when the death cross triggered.
Ah, okay. So while the price averages were crossing negatively,
Exactly. The actual money flow, the big institutional money, was showing strength. It was being put to work. It suggests that, just because a traditional indicator flashes negative, you really need to look deeper at what's happening with the actual money flows, the underlying conviction.
so the lesson is, don't just rely on the classic chart patterns in isolation. You have to see if the money confirms the move.
Precisely. That BMI rally indicated underlying strength that contradicted the surface-level death cross signal.
Fascinating stuff. Okay, so what does all that mean for right now? Because we're talking about a golden cross for the S&P 500, which reportedly just triggered. What's a golden cross? Is it typically seen as positive?
Yes, it is. A golden cross is basically the opposite of the death cross. It's when the 50-day moving average crosses above the 200-day moving average. And yeah, it's generally considered a positive omen, a bullish signal for the market. The Nasdaq actually formed one just last week, and now the S&P 500 has followed suit.
And when was the last time the S&P 500 saw this specific signal?
The last time was back in January 2023.
Okay, so the million-dollar question, as our source puts it, is what comes next? They provide some pretty compelling historical data for the S&P 500's performance after a golden cross. What did they find?
Well, they looked at weekly data going back about 30 years. Over that whole period, they found 14 prior golden crosses for the S&P 500. And, stocks generally did moderately well afterwards,
Okay.
the returns. However, and this is the key part, specifically looking at the period since 2009, this signal has been remarkably effective. It's been a consistent market-beating signal since then.
Market beating. That's a strong claim. Can you share the specific numbers, like the average gains they found after a golden cross since '09?
Absolutely. The average gains they calculated were, 6.5% over the next 3 months, then 10% over 6 months, 14% over 12 months, and looking out further, 33.3% over 24 months. Pretty significant, consistently positive returns.
Wow, those are some solid numbers, especially over the longer time frame. So just based on history, this golden cross suggests more gains ahead, maybe for the next year or two?
That's what the historical data since 2009 suggests, yes. It points towards continued medium-term strength.
So why is this happening now, do they think? And how does this idea of forced buying fit into the current rally?
Right, forced buying is a key concept here, according to the source. They use it to put this current rally into perspective. Think about institutions like big funds that might have de-risked earlier. Maybe they sold off stocks anticipating trouble. But now the market is ripping higher. They start lagging their benchmarks, sometimes significantly. So to keep pace, maybe even just to keep their jobs or mandates, they're essentially forced to buy back in. They have to chase the rally.
So it's like institutional FOMO, fear of missing out, but with like potentially billions of dollars behind it. They have to get back in to avoid underperforming.
Exactly. It's a powerful dynamic. They're compelled to buy, sometimes irrespective of valuation, just to catch up.
This sounds familiar. Didn't something kind of like this happen during the recovery after the 2020 COVID crash?
Precisely. The source makes that exact parallel. They state that the extreme panic and selling, the capitulation, back in March 2020, triggered massive forced buying on the way back up. And they see the same pattern potentially shaping up now in 2025. They explicitly note the similarity. A sharp downturn, like the tariff situation potentially mirroring the COVID crash, followed by a strong relief rally fueled partly by this forced buying. And we're seeing evidence of inflows too. This year, we are actually seeing some of the largest equity inflows all year.
Okay, so putting it together, we've got this historically bullish golden cross signal, plus potentially massive inflows driven by this forced buying dynamic. That sounds incredibly strong. But I mean, this kind of intense buying pressure, it can't last forever, can it? Are there warning signs we should be looking out for? Signs that maybe things are getting a bit overheated, even temporarily?
That's a really important point. No, the current magnitude of these inflows likely can't last forever. And the source does point to a specific signal they use to identify when a potential blow-off top might be forming. They call it a forced flow trigger, or FFT for short.
Okay, FFT. What exactly defines this trigger? How would someone spot it? Is it a chart pattern or based on inflow numbers?
It's based on the inflow numbers. An FFT is marked anytime they see a really big surge, specifically over 400 equity inflows within a certain period. They mention 400 plus equity inflows. Now, while that spike itself might seem small on a long-term chart, they've observed a pattern around these FFT signals. Typically, leading into an FFT, the major indices rally quite hard, say in the 2 weeks before it triggers. But then, in the 3 weeks following the trigger, the market often pulls back. It suggests a temporary exhaustion point.
So it's like a final burst of buying before a pause or a pullback.
Kind of, yeah. They highlighted past examples, too. FFT signals triggered in November 2024, December 2023, and February 2023. And the pattern held rally before, dip after.
Interesting. So the big picture from the Golden Cross is bullish medium term, but this FFT is like a near-term yellow flag, a warning of a potential, maybe healthy reset.
Exactly. A healthy reset is how they frame it. If this blow-off top, marked by the FFT, does trigger, they expect a pullback. And they offer a word of caution. If the major indices fall, say, 4%, the higher growth stocks that often lead these rallies could potentially fall much more, maybe 10% or even more.
Ouch. So given the forced buying we're seeing now, it's crucial to be alert for that FFT signal, even if the longer-term trend looks positive?
Being alert is definitely the key takeaway there, yes. The forced buying adds fuel, but it can also contribute to these sharper, faster exhaustion points.
Okay, let's wrap this up. So what does this all mean for you, the listener? We've really covered a lot of ground here. We talked about the surprising bullish read on a death cross when you look at underlying money flows, not just price. Then the historically strong signal from the Golden Cross, especially its power since 2009, suggesting medium-term upside. And we unpack this idea of forced buying as a major driver behind the current rally's intensity.
Right. But critically, we also highlighted that warning signal to watch for this forced flow trigger, or FFT, which could flag a near-term, possibly sharp, but likely healthy market reset. It's really a fascinating look at the interplay between technical signals, investor behavior, and sentiment shifts. How quickly things went from quite pessimistic to this very risk-on environment. And it really underscores the importance of maybe looking beyond the conventional wisdom sometimes and trying to understand those underlying money flows.
Absolutely. So as you think about all this, maybe consider how these specific signals, the Golden Cross, the FFT, and these historical patterns might frame your own view of market volatility right now. If history is any guide here, understanding when to potentially expect a strong climb versus maybe bracing for a sharp short-term correction could be incredibly valuable as you navigate what's happening. It's less about perfect prediction, more about understanding the forces at play. We really hope this deep dive helps you feel a bit more informed and maybe better equipped to make sense of the complexities in today's market landscape.